All right. Welcome, everyone, to the 7th webinar in BALLE's Accelerating Community Capital Series. My name is Alyssa Barron, and I serve as BALLE's Co-Managing Director and Network Services Director. And we're delighted to have everybody with us today for our webinar on the No Small Potatoes Investment Club, which is an initiative of Slow Money Maine. We have about 85 folks registered for the call today, many of whom will still be dialing in as I complete our housekeeping notes here. So note, if you're dialed in by phone but have not joined us in the webinar room, please find a link in your reminder email from Allie Walker so you get the visuals as well as the audio. Because of the number of call participants, as usual, we have the phone line muted. That means if you have a question for the presenters at any time during the webinar, please type your question in the public chat window. The presenters may answer a question during their presentation, but we'll hold most questions to the end of the webinar when we have time set aside for moderated Q&A. If you have any technical difficulties during the webinar, please note this in the chat window, and our staff member, Allie Walker, will contact you to assist you. You'll see that she will send you a private chat. So on the right side of your screen where you see the public chat window, there'll be a private tab that pops up with Allie's name, and she can help you resolve any technical difficulties you have that way. So again, our Community Capital webinar series is held the first Tuesday of every month at this same time, 10 a.m. Pacific, 1 p.m. Eastern. The series has been running from February through December 2011 and is co-hosted by RSF Social Finance and Slow Money. Additional series partners include the Association for Enterprise Opportunity, or AEO, Portfolio 21 Investments, and Investors Circle. As many of you know, this series is explicitly focused on tools you can take home and try out right away. So each month we feature a case study with a community capital innovator or innovators, folks who have developed and piloted working models for connecting local people's investments and businesses and farms to local needs using local resources. The innovators present their model, and we always allow time for dialogue and questions. So we suggest that you treat these calls as an opportunity to bring together a group of folks in your community, business owners, social entrepreneurs, lenders, philanthropists, investors, anybody who's interested in a particular topic. And after listening to the webinar, you might spend an hour discussing with your group the applicability and relevancy to your community. You won't have to pay extra per attendee on the same webinar line. So we know that our networks in California and Alberta and a number of other locations are doing this. They're bringing groups together in their community. They all listen to the webinar together, and then they immediately talk about whether or not that model is replicable and how in their place. And in that way, they're really jump-starting their community capital efforts. So we invite everyone to do that. A couple final reminders. There is bundled pricing available for the webinars. So if you're not already signed up for the full series, you can register now for the October through December webinars as a bundle and receive a 33% savings off the cost of each webinar. You can find details about that and register at our website, livingeconomies.org. We also had an all-day workshop intensive in June, immediately preceding our annual business conference. And if you weren't able to join us, or if you did and you'd like to keep referencing that content, for a low price, you can order that content off of our website. So again, go to livingeconomies.org, and if you go to the events tab of our site, you'll see our community capital page, which has details about past calls, forthcoming calls, the workshop, et cetera, et cetera. Next month, we will be featuring the SOUP model for supporting small businesses through local crowdfunding and community engagement with John Kohler, president of Friends of Spalding Court, and the founder of the Soup at Spalding events in Detroit. So stay tuned. It will be an excellent webinar, and we hope many of you will join us. So for today, we have with us Eleanor Kinney and Chris Hallweaver, founders of the No Small Potatoes Investment Club, which is an initiative of Slow Money Maine. The club has been pooling funds and making microloans to farmers and food businesses since the fall of 2010. And they're going to walk us through today how they got started in that process, how it's worked so far, what they hope to accomplish, and some thoughts about replicability for other communities. So with that, Eleanor, I am going to turn the floor over to you so you can get us started.
Great. Thank you so much, Alyssa. As Alyssa mentioned, my name is Eleanor Kinney, and Chris and I are both founders of No Small Potatoes. It's an investment club. We are providing microloans to Maine farmers and food producers. And I'm going to give you a bit of a framework for why and how we got into microfinance in agriculture. And Chris is then going to give you more of the details and a step-by-step. So we're here talking to you because we feel what we're doing is not only meaningful and exciting, but highly replicable. And I know that's the goal of this series. But we've created a model that we hope will resonate with you and that you'll take home and try out in your own communities. No Small Potatoes is grounded in the principles of slow money, in bringing money back down to earth and investing it as if food, farms, and fertility mattered. Bottom line, we all need to eat. We need to eat every day, and we're no longer growing food in ways that take care of the soil, take care of our communities, and nurture our own health. So Slow Money has a goal that if 1 million people invest 1% of our assets in local food, we can start to change all that. And put that way, it feels really doable and something we can all be part of as consumers, as producers, and as investors. I'd like to say that this is a work in progress. We jumped into this. We're learning as we go, and we're sharing what we learn. And we hope we'll be able to answer your questions, but we certainly don't have all the answers yet. So today, again, I hope that you'll take our model and learn about it and figure out how to do it yourselves. We have a goal of trying to establish 10 new clubs by the end of the year or early next year. And we have had inquiries from all over the country interested in No Small Potatoes, and we hope that some of you will be interested in starting another club. So how did we get going? We all began meeting last year as part of Slow Money Maine, and we're a group of investors and food producers and farmers and nonprofits that all have a focus on rebuilding a local food system in Maine and matching capital with need. And what we found out is that the need is on both sides. We have farmers and food producers whose capital needs are not being met by existing financial institutions. And we have investors and people looking to leverage their money in ways that fit their values and benefit their communities. People are really looking for an alternative to investing in the stock market, and we are trying to create the tools to provide that. And in Maine, too, we've got land, we've got water, we've got light, but we don't have all the financial tools, and we need more investors and more assistance for these businesses. So that's really what we're trying to get going. And with No Small Potatoes, we are starting small. This is microloans. We do loans up to $5,000, but we're using it as a way to experiment and to learn. And by creating a structure, we're trying to make it easy for other people to get involved. So we've established the club. We've done the hard work of creating the structure and the documents, and now people can come on board and just learn from the experience of making the loans. And so as we create more and more tools, we hope to get them out there so that people can just pick them up and start making changes. And again, we're doing small-scale loans, but it's a launching pad for bigger ventures, and I will speak more to that later. So last summer, not this past one, but 2010, as we were meeting with part of Slow Money, we started learning about farmers that had immediate needs that they were not able to get met by local banks. And these needs included being able to buy goods in bulk, being able to buy equipment, and these farmers and these business people were cash-strapped and often highly leveraged, but they had good businesses and good products, and they had markets. They just needed capital. So we learned about some of these farms. The first one here, Hiwa Tofu, they were buying soybeans from New York to make their tofu, and they wanted to buy Maine soybeans. So to do that, they needed to have a lump sum, $15,000 up front, which they didn't have. And so they were looking how to get that capital in order to be able to buy their soybeans locally and have more local impact. Another farm, 30-acre farm, grows the most beautiful cabbage and makes the most beautiful sauerkraut, and they needed to update their labels, so they needed several $1,000s, and again, we're looking for cash. And then we had Lalabella Farm, and they were going week by week buying their ingredients, and for them to be able to buy in bulk, they were going to reduce their operating costs and increase their profit margins. So we got introduced to all these farmers. We learned about what they were doing, what their needs were, and we got really excited about it. And we thought that we would just dive in and start helping these businesses, helping these families, and making a difference. So a group of us got together, and we sat down with our checkbooks, and we made loans. We made loans directly, one person to a business in this case, and these businesses got off and running with what they needed. And it was a great experience, but we recognized that that's not how we wanted to continue to do things, that we wanted to create a structure that would work for ourselves, that would bring more people in, and we were very interested in pooling our funds instead of doing one-to-one loans, in part to spread the risk, because if one of these farms ran into a problem and wasn't able to pay back that loan, that would then all be on one person. If we pooled our funds, we could spread that burden and also spread the returns. So we thought about how do we pool our funds, and how do we do this without big upfront legal and professional fees, and how do we do this while still being in compliance with SEC and other regulations. So those were kind of the questions that we had about how to create a structure. And again, all of this was in order to meet the goals of helping farmers and food producers in Maine rebuild the local food system, and for us to begin the process of moving money from Wall Street to our local food system and our communities where we felt like our money could have a much bigger impact. So that's what we're looking to do, and Chris is going to take us through and talk through some of the details.
Thanks, Eleanor. So at this point, late last summer, we were making loans, and we had a very nice group forming. In addition to Eleanor, Lindsay, and myself, the three original members, Sally and Kelly joined our group. So frankly, we could have continued under this mode for a little bit longer, but we really wanted to pool our funds and make it a little bit larger endeavor and more important endeavor. So we set about figuring out a way to do that. So we did consult with attorneys and other financial type folks to see if we can't simply do what we wanted to do, is pool our money and make loans. And initially, the attorneys were putting up some roadblocks and were worried. And if you've ever dealt with SEC attorneys, it appeared to me they were making things more difficult than they had to be. But we had to respect that. We looked at credit union. I mean, who wouldn't like a slow money credit union? Or I would love to take the 5% of my salary that goes to Wall Street into some mutual fund that invests in some multinational corporation. I'd much rather have that mutual fund invested in Maine farms. But those vehicles don't exist. They're working on them, and eventually we'll have them, I hope. But certainly not today. They don't exist. And besides, I really like that personal connection. We get the peer-to-peer aspect of what we're doing with the farms. So we were introduced to the investment club idea. So the first thing I want to emphasize is the model that we chose is a very popular model. There are literally thousands of traditional investment clubs around the country. I invite you to Google investment club right now, and you'll see over 4.5 million hits. So we didn't invent something for this purpose, but our goal was to try to use this model and just tweak it a little bit. So instead of traditional investments, we could be making these loans to farm and farm producers. So an investment club is simply a group of people that meets regularly. They pool their funds and they make investments. Well, that's great. That's exactly what we wanted to do. And typically there's a profit motive and an education component. Again, great. We were all for that. So it seemed like if we could make loans to farms under this model, then it might work for us. So the investment club that I was associated with, now this goes back to the 1980s, And it was a group of guys. There was about 20 of us. We met monthly. Everybody chipped in $100 a month. And each month a member would be assigned to make a recommendation for a stock purchase. These investment clubs are just, traditional investing in over-the-counter or New York Stock Exchange firms, publicly traded firms. So a member would get up and make a presentation, make a recommendation. The group would vote on it, and our club created a nice little portfolio. We learned a lot about Wall Street, and like I said, there are thousands of these clubs in existence today. Some have been around for decades, and it's a great idea. So we set about wondering whether we could just use this model and whether loans to farmers would be okay. So our first call was to the state of Maine Securities Office, and they researched it, and they came back with very positive findings, no roadblocks. So we kind of went forward and we formed our club. So the main advantages are the SEC has recognized investment clubs. They've provided very easy to follow guidelines, so it's a very safe way to create a loan fund. It works. It's proven. And what I really like about it is now our club is getting larger. We've recruited new members. So there's a dozen or so new friends of mine that share a common goal that I wouldn't have known otherwise. Eleanor, I did not know, prior to this endeavor. So it really has enriched my life. I've gotten to know farms personally. So besides doing good, helping the farms, I really, from a personal point of view, it's been wonderful. So I hope you guys would consider starting your own and realize it will be a great experience, or can be a great experience. To that end, we've created 5 simple steps that you want to follow, and if you do so, you'll have your own club. So the first thing, and our first piece of advice, is don't do it alone. Find a couple partners, some friends, some colleagues that share your vision, and kind of spread out the work. There's not a lot of work, but there is some work to get this started. And always remember, there is some risk to what we're doing. There is a reason why banks won't make these loans. They tend to be a little bit riskier than what they're comfortable with. So you want to make sure you recruit members that will understand exactly what we're asking of them. So step number 1, don't do it alone. Find some founding members. The second step is set up your policies for your club. And we're going to share with you our operating agreement. And you can use ours, or you can adopt your own. So, for example, we'll get into this later, some of the details. But we've decided to limit our club to, for the first year anyway, to 20 members at a minimum investment of $5,000. So that means we have a $100,000 fund. So that's a fair bit of change. So you want to make sure, given that you've got rules and an understanding of how your club's going to work. And again, not hard, but you want to go through and set up how you want your club to run. Again, follow the SEC guidelines. Number 3, we are suggesting you create a legal entity. Now, it could be a very simple general partnership. That's how most of the traditional investment clubs are. So it's simple. You don't need an attorney. There are lots of templates available that you could use. We elected to be a limited liability corporation. And we did consult an attorney to draw up our papers, a little added protection there. But you do whatever is comfortable for you. So at this point, you want to start identifying farms and food producers that requiring some capital. And it's important that you set yourself up for success, especially in the beginning. It does take some courage to make these initial loans, so be courageous. But deal with farmers with good reputations in the communities, hopefully farmers you know. Make a visit to the farm, get to know them. And I'd like to suggest that you want to start off by identifying small projects that needed to be funded. And it's important that if the farm or a food producer needs, let's say, $30,000 for a project, and you're only providing $5,000 of it, as much as you like the farmer, it perhaps won't do him much good if you're only providing a portion of the needed financing. So find nice, cherry pick some nice projects that you think will be success. And step number 5 is real simple. Make the loan. You're ready. Do it. It is important that you make, or we recommend that you make loans to companies, not individuals. There's some consumer protection issues. Excuse me. I went back. There are some consumer protection issues with individual loans. So make it to the company. Even if it's an individual, do it as a DBA. Make it recognized to the company. Write it down. Make sure the terms of your loan is understood by both your club and the borrower. So we have a promissory note that you can take a look at and adapt for your use. And lastly, feel good about it. As I mentioned, it's a wonderful way to help. So let's review. Get some founding members. Don't do it alone. Get your policies in order. Create a legal entity, number 3. Start identifying producers that need loans and make your loans. 1, 2, 3, 4, 5, and you're done. I'm going to talk a little bit about loan decisions because that's hard. There's a basic dilemma in that we are not a bank, but we want to be profitable. That's something we haven't really mentioned. We do charge interest. It is a low interest loan. We do believe in slow money, but we need to be successful to continue making loans. If we make bad loans, then our club will not have the capital to continue making loans. So you've got to figure out, exactly what makes a good loan, and you'll learn over time. So that goes back to my earlier advice. Cherry pick those first loans, do small projects, and you'll learn. Now we make the decisions on the loans largely based on character, references that we talk to. We visit all the farms, and we get a degree of confidence through that. But it's important to look at the financials too. Most of our members are not have a financial background. They're not accountants, so we are learning about this. But it's not that hard. But I think it is important to establish that if these businesses want to grow, they've got to have good financial systems in place, and it's important to recognize that and help them along to that. And in our case, we do require that. I think a nice way in which you could justify some of these loans is if the borrower can explain simply and shortly how will the loan be paid back. So going back to Jeff, the tofu maker from Camden, Maine, in his case, he had already established that he had the cash flow to pay the loan. He was buying his pesticide-free but not certified organic soybeans from New York, and by arranging for a crop to be sowed for him, he could have Maine organic, certified Maine organic, and of course be local and all sourcing from Maine product. But again, that required a whole harvest worth of purchase. But to us, we were users of his product. We loved his tofu, and we had a lot of confidence that his business would continue to grow, and he'd be able to pay that back. So that was an easy first loan. Some of the details of our group. As I mentioned, we've limited the first year to 20 investors. There's no magic number in 20. We just wanted it a big enough number to make a difference, to get some group dynamics going, because again, the idea is to share the risk and to learn from each other. But we didn't want to make it too much where the meetings would be difficult to manage, and it'd be an accounting nightmare. The most important rule to understand from the SEC point of view and how you want to stay as an investment club by their definition and not get into any trouble is all the participants, all your members of the club have to be active. And that means you can't have 1 or 2 people making the decisions on whether to loan or not. So they're equal participation among all members. That's key. we decided to make a minimum investment amount of $5,000. We wanted it big enough to make a difference. So there's the 20 investors times the $5,000. We thought $100,000 would be a good starting point for a loan portfolio. If we made it much smaller, we would have had too many people, and we wanted to make sure we were taking baby steps, one step at a time. So we felt that was good for us. We've defined a microloan between $1,000 and $5,000. We've elected not to lend money to startups. So the borrower has to have existing cash flow. They need existing customers and products and services that we could understand and test and talk to. So what we have is we're going to do 3 loan rounds this year. And as a loan application comes in, we assign it to a 2 or 3 person team to evaluate the loan application. They have conversations with the farmer. They schedule a farm visit, and then they present to the members, and we take a simple vote whether to fund the loan or not. Our loans are at 5% currently, and as it turns out, on the original loans back the summer of 2010, when we were making individual loans, we did them at 3%, and that we felt that was low, but still gave us a little bit of a return. But as a group, we decided if we were going to make some money, and there are some expenses associated with the club, and as much as we want to make good loans, perhaps eventually one of the loans may be delayed paying back or go bad. So we upped it to 5%, still very low, but more than that initial amount that we wanted. The terms have been from 1 to 3 years, and we've elected not to collateralize any of these loans. I'm not sure what we would do with a tractor if that was the collateral and the loan went bad. So these are no collateral loans. We did hire an attorney. We're going to have a little bit of accounting expense. There's some miscellaneous stuff. So we've asked every member to kick in an extra $100 to cover for those expenses. And just to repeat, I think it's important that all your members understand that we are doing something that has a risky nature, and their money is at risk. So we're going to do 3 loans this year. We do have officers in our corporation, in the club, and we've split the work into 4 different areas. So for instance, Eleanor deals with recruiting new investors, new club members, recruiting borrowers, sending out the loan applications, answering questions to get the application in. That's another job. This accounting. Now this is very necessary. You got to track these loans. It's not hard, but you do need somebody with some accounting background. We've created a nice spreadsheet that makes it easy, but it is loans and interest rates, so that's a necessary item. And finally, we've added a component to our club to share our investment club model. That's kind of what we're doing today. Lindsay Weld, who has been on holiday, a long scheduled holiday, would normally be doing this seminar, but she was unavailable. But she's the one in our group that can help you if you have any questions. Of course, Eleanor and I can help too, obviously, but that's how we've kind of split the task as far as the officers of our club. Something we want to do more is add some social aspects to the club. For instance, when a new member wants to join, we feel it's important to get to know them, so we kind of arrange a meeting for some of the group at a coffee shop or at a lunch, so we get to know some people, and that will work out well. So that's our model. I see there's some questions there on the left here, but I'm going to have Eleanor wrap it up, and then we can take some questions.
All right. Thanks, Chris. A couple things too about this, where we're looking at no small potatoes as microloaning and as an experiment, but it's also been a great entry point to other things. And we've made a point of publicizing the club. Chris and I have been, we were interviewed for the newspaper. There's been stuff on radio and TV. And I saw there was one question about how do you recruit applicants, and part of it is getting the word out and getting people to understand that No Small Potatoes exists. And we have the Slow Money Network does that as well through our meetings. We have groups like Maine Organic Farmers and Growers Association that puts it out through their networks. So you get the word out, and that helps us get applicants applying, and it also helps us in recruiting new members. And the new members that are joining our club and asking about our club, I think of in terms of both great for the microloan work, but also for the other work that a number of us are getting increasingly involved with. And that's what we mean by the gateway to larger scale projects. Chris and Lindsay and I and others are all involved in investing in infrastructure projects in Maine, in grist mills, in food processing operations. You know, on the stock market, I own Coke and Pepsi. In Maine, I'm an investor in Moo Milk, an organic milk company. So it's a great stepping stone for getting people at a fairly modest entry level of $5,000 used to the idea of doing something different with their money. And in these bigger projects, we're looking, again, at patient loans. We're also looking at being equity investors. So there's a continuum of needs on the side of producers and farmers, and there's also a continuum in the kind of tools we're trying to create to get capital to meet those needs. So that's something I just wanted to bring up as an important aspect and kind of goal around forming this loan club. And again, there are lots of, there are different ways to do it. Our model is working for us. I mean, part of the work in progress, too, has been figuring out, we have tweaked and modified the loan review process as we go along. I mean, Chris has mentioned how we started out doing 3% and then we went to 5%. We decided that site visits were really important. I did one interview over the phone, and it was very difficult, and it was by going to the farm in person. I mean, this was actually an immigrant farmer from Sudan. It was a completely different experience, and seeing the farms, making that personal connection has been a really important part of our process. So that has worked for our model. But the big thing is just getting in there and doing it and not waiting, and working with people that you develop a working relationship and trust with, and working out the kinks as you go along, and then sharing that information. And that's why we want to get more clubs, and that's why we want to share all our documents. And we've got links to all of that, which we can show you as well. So we're really encouraging people to get started and get involved, and it'll be great to answer your questions.
All right. Thank you very much, Eleanor and Chris. I've just loaded your website for folks who want to make note of the URL for later reference. It'll be in your copy of the presentation, which you'll get. Everybody will get access to afterwards. I'll mention that at the end of the call. But we've also got it pulled up right now in the webinar room, www.NoSmallPotatoesInvestmentClub, and you can see that Chris and Eleanor and their colleagues have very kindly shared some sample materials and guidelines for you to access in both PDF and Word format. So we've had a lot of terrific questions coming in through the chat room. So I'd like to serve these up, Eleanor, to you and Chris, kind of first dealing with the basic structure of your club and why you set things up the way you did, then moving to some of the questions about who can lend and how members come in and out of that, and then finally moving to a bunch of questions about the loan terms and kind of the details of how you make that loan with the folks you decide to fund. So let's start first with some questions about your structure, and I'll invite either of you to answer or both as you see fit. So why did you structure as an LLC instead of a partnership? You mentioned, Chris, that many structure as a partnership and that there's some more structure, of course, in limiting your liability. But if you could speak a bit further to that. And there was another question, who's responsible for generating the deals? And somebody else had a related question. Was a credit union an option that you considered? So can you speak a little bit more to why you set yourselves up as an LLC?
Sure. I actually, when we first started, I looked online and I found a lot of sample partnership agreements, and that seemed to be the common one. So that's how we worked up, and that was the goal. But as we identified new members, there seemed to be a sense in our group that they wanted the added protection of a corporation. So it was really just a comfort level that we did it. My own personal view, either one would have worked, but that was really a function of the group dynamics and what the group decided. I'll go back to the credit union idea. Is a great idea, and I know there are a couple of people working on it, and I hope they get it working. But we wanted to do something now, so I'd love a credit union all devoted to local agriculture.
I'll speak to the deal flow a little bit and also to the default issue. As I mentioned a little bit earlier, it's really been largely word of mouth. People can find us through Slow Money website. We're starting to set up our own website for No Small Potatoes. We've got a number of nonprofit groups that include us in their email communications, as well as trade groups are starting to do that through the kind of work we've done in the media to get the word out. So, and all of us are trying to, we talk it up at farmers markets. We walk the walk and talk the talk. We are out there, meeting farmers and going to markets and trying to get the word out. Now, that said, we had quite a few applicants this spring, but we only had 2 this summer. And we don't know if that was a failure in recruitment or if that was just a factor of the summer being really crazy. So we've actually initiated a survey from people who contacted us but then didn't actually apply to better understand if that was a timing issue and that it really doesn't make sense to have a summer loan round. We are thinking of just really focusing on early spring and later in the fall next year. So again, that's the part of kind of tweaking things. And then we're also just making sure that the application feels accessible for people. This is part of, trying not to be a bank, but trying to do enough due diligence. We want people to feel like that they can fill out our application easily and provide us with the documents, but we do need balance sheets. We do need to look at their financials. So it's striking that balance. Thus far, everybody's been paying us back. That's true of the individual loans that we made early on, and that's true of the loans that we have made thus far through the pooled fund. And philosophically, when we decided that we weren't going to collateralize these loans, we did decide that if someone defaulted, we would try to work, with them first of all, see if we could redo the terms or, figure out ways to make it work. But we made an agreement as a group that we weren't going to take legal action against someone if they defaulted on a loan.
So that means, Eleanor, that you'll try to redo the terms and make it work and ultimately try to get that money back for your club members, but ultimately if they don't repay, it just gets handled as a loss, or that's your thought about how you'd handle that?
Yes, it's going to be handled as a loss. But the other thing, too, and this gets back to the relationship piece and the peer-to-peer piece, is that these farmers understand, it's a community of farmers, and everybody that we've loaned to, we send out a form asking if they're willing to have their farms be named publicly as a recipient of our loan club. All of them have been willing to do so. All of them are interested in getting their names out there that way. And I think there's a hope in this sort of peer-to-peer network that if they default on our loan, they're not just, letting us down in terms of the club, but they're letting down their peer farmer community, because if people default on their loans, it makes us less able to make loans either again to them or to other farmers. So that whole relationship piece is important. And when we've talked to MOFCA, the Maine Organic Farmers and Gardeners Association, they run a loan program as well, and they've not had defaults, and they have a longer track record. So we are hopeful that that this is really going to work, and we're actually going to be able to get some return, and that we're going to be able to make good access to capital for these farmers.
Thank you. So we've had a couple of questions about what happens when a member wants to get out of the club. So you've already said in terms of joining that that you'll allow up to 20. It doesn't sound like you've got 20 yet. So it would be helpful to understand, how folks as new members may want to join, how they get cycled in terms of your loan cycles throughout the year. And then when they, when or if they want to withdraw, what was your plan for handling that?
well, I think we can probably both speak to this, maybe Chris better because he's doing the accounting part. One of the work in progress things is I have to be upfront, and this has been sort of interesting as the recruiter too, that we haven't completely formalized the withdrawal piece. And I'm upfront with people when they're joining the club about that. Our thinking has moved as far as that people can withdraw money from the club. There's going to be an opportunity to do that just once a year. And we're not going to have all the money of the club loaned out at once. Like of the first 100,000, we'd want to loan out 90 to have a cushion for losses or for withdrawals. Chris, you can speak to, I mean, it's calculated on an ongoing basis in terms of how much everyone's put into the club, what the return is. But we are still formalizing that withdrawal process. Do you want to add to that, Chris?
Well, sure. So, theoretically, if everybody's paying, which they are right now, but we're a new club, just so you know, as a pooled fund, we have 8 loans outstanding for $35,000. So I think 4 or 5 were at $5,000, our limit. We had a couple at $4,000 and one at $2,000, I believe, and they're all paying. That generates, again, the terms are different. So some are just 1 year, some are 3 years. But in terms of our portfolio, currently we get about a little over $1,000 a month. So that gets put back into the club, and our minimum investment, as we mentioned, is $5,000. But we actually had one member that put in $10,000 to start. So we keep track of shares. So anyway, if all is good, we always know what the value of a member's share is. The problem is if a loan starts to get late, and if it's just a little late, that's fine. You make a phone call and you take care of it. But at some point, the late payment becomes a loan at risk. And at some point, you got to determine whether that loan is good or bad, and that affects the value of your loan fund. So when somebody leaves, you've got to make a determination. So we're just working through the details about when we do that. As Eleanor mentioned, we plan on leaving enough funds unloaned, if you will, for 2 reasons. One is to deal with folks that want to leave. But secondly, the thought was that there's emergency loans, we want to always have funds available if something comes up that we want to help, immediately. We also talked about making it so you can't leave unless you get another member to join. That's one way to work, and that may work. So we'd be open to any other ideas folks have on how to deal with that issue. In the reality, I don't think it's going to be a problem with our 20 members. I don't think, Eleanor, we don't have 20. I think we've got like 15 or 16 that have signed the paperwork, and we've got a couple more lined up.
Right.
So we're just about there.
3 or 4 more that are about to join. So we're starting to, as we close in on our 20, to be a little more conscious of different skill sets. Like I've been working actively with someone who is a securities lawyer who's going to join the club, and trying to. We don't have a retired farmer. I'd love to get a retired farmer. So it's as we kind of round out the final numbers, there are just a few. Just like you're trying to put together a board, there are a few sort of skill sets that I'd love to bring in. But we've gotten more and more business people on board, which has been great. And another decision that we had to actually come into is whether this is part of the active participation thing, and that is an SEC requirement because you're not allowed to be managing someone else's money. So everybody votes, and you have to have majority votes to make decisions. And but for instance, we have one major investor who doesn't come to the meetings, but instead his staff person comes. So it's sort of he's represented, and we decided that was, as a club, we decided that was okay. It didn't have to be the actual person writing the check, but they could have a staff person come represent them. We also have been very clear about, we've had a couple husband-wife teams want to join. Well, it's one member, one vote. So if you join the club, it's your vote. You don't have 2 people join on one $5,000. So these are some of the sort of policy things that we that we worked out. I saw a question about, is it $5,000 every year? So far, everyone's just put in one $5,000. It's revolving. We're getting paid back, and we're going to reloan out. One person's put in 10. I think a number of us are willing to put more in as we grow, and if we don't have enough money to meet the number of loans that we think are good loans. But thus far, there's not a requirement about everybody putting in an additional $5,000.
And there were two other questions related to kind of the members and how that works before we move to some of the questions about the terms and details. One was, we've had a couple variations of this question asked, if you're profitable, will you disperse dividends to the members or reinvest the money? Is there a structure of proceeds, rollover payment, et cetera?
Sure.
How will you handle that?
Sure. What we decided was at the end of the year, we're a limited liability corporation, so we're going to, there's a tax. Our earnings will be taxed as an individual, so we have to create those forms. At that time, the interest, and a member can elect to take the interest earned as a dividend, if you will. It's a small amount of money. It's only $5,000 at 5%. But kind of out of principle, if somebody wants to do that and marvel at the interest earned, they can do that. So most of our members are just going to kind of roll it over, and our fund's going to grow.
All right, and there was a question also about since you have $5,000 as a minimum, and that's what you decided, but there, of course, that's a one-time contribution, but folks can contribute more, and they may decide to as you continue to grow. Somebody also asked, do you have a sense of whether there's kind of a maximum for an investment club like this, a maximum that would be blessed by the SEC?
Oh, from an SEC point of view, they've provided no guidance on that whatsoever. I know the club I was involved with had been going along for a decade or two. The amount of money was significant. I mean, it's $100 a month, but it's...
Isn't there a cap on the number of members, though, of something like 100 people? I thought there was is there a cap on...
Well, there's in the state of Maine, there's an LLC cap. We're a little unclear on that. We'll have to clarify that for you. I don't believe from an SEC point of view. I don't know. I'm sure.
But one of the reasons why we picked 20 was one to get enough money and balance that with having it be manageable enough, because we have to, we sit down, we meet together, we run these meetings. We are statewide. We have people from around the state. So what we've done is we have conference call capability where we meet so people can call in. We also have developed a proxy system so that, for instance, at the last meeting, 2 of us held proxies for members that couldn't come. We have a 2-step process of loan review. So we meet initially during a loan round, look at the applications we've received, decide which ones we're going to pursue, and then we divide those up amongst the members and have 2-person teams that do the due diligence, do the site visit, write up a report, and then, give that back to all the club members to review. And then we have a second meeting where we make our final loan decisions. So that's the process that we've developed. Some members have chosen thus far not to be part of the actual site review process, but have participated and voted. So there are varying levels of participation. We haven't had a problem getting a quorum at meetings thus far, and again, having the conference call capability has been helpful. And Chris has been great about setting up. We have a Ning site, so there's we're going to roll over to a website, but there's a way for everybody to access the documents all online. So we're trying to make it as user-friendly as possible for our members.
And Eleanor, you were correct. I'm just reviewing the SEC document right now, the guidelines, and your club cannot have more than 100 members. That is an SEC requirement.
Great.
That would be a big meeting to manage, so you're better off having multiple clubs probably, or some other sort of way to figure it out.
Sure. Thank you. That's all very helpful. there also were some questions about, and you guys have, I think, explained this in some additional detail since the first question came in, about how you find potential loan recipients in the process you just described, Eleanor, of doing the site visits and creating a report and and having the multiple meetings with the team. Do you also drop a contract with each business? What does that look like? If so, have you ever asked for a credit check? And then we were also asked, as a part of setting up that process, a contract or otherwise, with with each business, is there any mentoring that you do, or say perhaps mentoring you would connect those folks with others? Somebody suggested Maine SBDC. So do you do a contract? Is there a credit check? Is there anything like mentoring beyond the loan?
The answer is yes to all three. So we do have a very active Small Business Development Corp, and some of our members are already working with them. Some of these farms do not have the financial record keeping that they need, that we feel comfortable with. So we are working with them and invite them to kind of apply next year and try to help them. As part of Slow Money Maine, we are setting up a technical assistance program that will kind of take one step beyond the generic help that is available. So we are kind of concerned that these farmers are expected to be not only great farmers and deal with growing the crops, but they got to be accountants and lawyers and marketeers and everything there. So we're trying to also, as a separate endeavor, kind of deal with some of that mentoring. I'm sorry, I've already forgotten the other two parts of that.
Contract, once you mention the contract that we do.
The promissory note we're talking about?
Yeah.
Mm-hmm.
I have that example. I hope people are clicking through that. That's taken some iterations there too, as well as our application has taken some iterations. When we first started, our application was like, tell us about yourself and how much money do you need. But we want to get a little more serious in that. These are loans that we want to get paid back, so we've kind of made it a little bit closer to what a bank does. As we interviewed other traditional loan folks, they all highly recommended we get their credit score. To every single one recommended that. We have not done that. However, we do talk to trade references. We do talk to customers. So we do credit checks, but we've elected just something out of principle. Plus there's a cost associated with it too, that we've not using that ubiquitous credit score. But the promissory note is a little bit more serious. Again, we don't collateralize the loans, but the terms are very much spelled out.
And on the mentoring front, it's not only are we trying to set up resources to provide mentoring, to the farmers, and particularly with these larger projects that we're getting into, where we're putting together kind of a SWAT businesses technical assistance team of sort of retired general managers and CEOs. But we've also been mentored and trained ourselves. We had someone from the Finance Authority of Maine come do a several-hour workshop with us where we went through the financials of one of these businesses and talked about what things mean, what to look for, because there is a range of experience in our club with dealing with those things, and nobody's made loans. So that's been really helpful to go through that training process, and we'll probably continue to do those from time to time so that we are able to have a comfort level with, reading those numbers and analyzing them and using them in our loan decisions. But as Chris mentioned, the references are important, not just trade references, but, character references, and we check within the networks, and we find out as much as we can about whether these farmers have a good reputation.
All right, thank you. I've got a small handful of additional questions I'd love to get through before I do a couple closing housekeeping notes here at the end of the hour. So we had a couple of questions about SEC rulings related to investor standards. So first is, can investment clubs make loans as non-accredited investors where individuals could not?
No, the beauty of the investment club is you don't have to be an accredited investor. So whether you are or not, you're welcome to join one of our clubs.
Perfect. Thank you for clarifying. And do equity investments involve meeting SEC qualified investor standards? I think the answer is really the same.
Oh, correct. No, we've elected not to make any equity investments in these farms and food businesses that we're dealing with, but we haven't ruled it out, and there's no reason why we don't. But we've elected just to do microloans.
Right.
Great,
but some of us are doing, equity investing separately from the club. But I have to say that in at least one case where I'm an equity investor, it was required that I be an accredited investor, but I don't know if they all required it or not. In that case, it was a requirement.
Okay. Thank you for that additional insight. And how long did it take you? I mean, you started this work really in the fall of 2010, and you've mentioned now the number of outstanding loans that you have at the moment. How long do you feel like it really took to get a sufficient number of investors to launch the club? It sounds like really the emphasis was on jumping in on these areas of immediate need and then continuing to grow the number of members and loans over time.
I think when we actually formed the LLC, Eleanor, I think we had 8 or 9 or maybe 10 members, correct?
Yeah, we had about 10 members. Yeah, because we started out with $50,000 from our first writing in the pooled fund, separate from the individual loans. And so we made those individual loans back in September, and our first loan round was end of April was when we were sending that money out. So that was the kind of, sort of a 6-month process, but it wouldn't take another club nearly as long because if they wanted to, because we've sort of, a lot of that was, the kind of stuff that we've now worked out and are in our documents and available for other people. The startup time should be quicker in terms of just the structure piece. And it just depends on, people's abilities to network and get together both the founders and the investors and to start getting the word out for applicants.
And I think there's going to be a couple of questions that we don't get to, so I'm going to suggest for any additional ones that come in, I would love Chris and Eleanor to just send those to you in an email, and if you had a moment to just answer a couple in writing, then we could, when we send all of the archive materials to the call participants today, we could get those couple of additional questions answered if you're willing. The one final question I would love to survive while we're all still live is, our premise in marketing your model for today's webinar was absolutely that this is replicable in other settings. That this isn't just a rural model, that this isn't just a food model. Of course, it's grown out of Slow Money's work in food. But do you have any thoughts about replicability in urban settings, in other sectors of the economy like real estate? Do you know of any particular examples of investment clubs that look similar?
No, I just answered that question as I was reviewing it. There's no reason we've chosen, local sustainable agriculture as our mission. But I believe if you do the due diligence on, whether it's in the urban setting or any other cause, that this investment model will work. Again, check. But when we talked to the Maine Securities Office, we used farms as an example there, but I don't think there was anything unique about farms that made it more applicable than any other business or mission or type of entity that you want to loan to.
Right. I mean, the broader picture is about investing in community, and rural, urban, California, New York, Maine, and one bit of networking that's really helpful too is, at least in Maine, we have these economic development groups that are nonprofits, and a number of them have loan funds where they do loans to businesses in their regions, and that fit their economic development mission. And they've actually been a conduit. They have sent applicants to us, and we've also made ourselves aware. Sometimes people come to us, and then we'll send them on elsewhere if it's for a larger project or something that doesn't fit our criteria. So it's important, it's useful to understand what other entities are out there doing community development, doing loans in your sector, and have dialogue so that you can get someone who's looking for financing to the right place.
Wonderful, thank you. Well, I want to remind everybody that after each webinar in this series, we email everyone a link to an archived version of the presentation, both the audio and the visuals. We also catalog the public chat room, so you have a record of the questions asked, and in some cases the answers that were typed in by our presenters, or the conversation back and forth between attendees. So please watch for an email from Allie Walker on the BALLE staff in the next couple of days. Again, next month we will be featuring the SOUP crowdfunding event-based funding model, featuring a particular example in Detroit. There's more information on our website. But for today, we're just very grateful to Eleanor and Chris for all the prep work that they have done in sharing their expertise and time today to help other communities hit the ground running. We know that you'll be presenting this work, your colleague Lindsay, you mentioned, at the Slow Money National Gathering, which is coming up soon as well. So in addition to the great work that you're doing, we really appreciate the amount of time that you're putting into helping other communities get started with similar efforts. So thanks again very much for your time. And thanks to all of our call participants as well for your great questions and lively participation.
Yeah, thanks for having us.
Thank you. Good luck, everybody.
All right.
Do it.
Thanks very much.
Yeah, and we'd love to hear about it. If you guys start similar clubs, please get in touch and let us know.
Perfect. Thank you very much. So we hope to see many of you on our webinar next month, including you, Eleanor, and Chris. So thanks, everybody, and have a wonderful day.
Bye.